Hello class, and welcome to this lecture on long-run economic growth in our course on macroeconomics. To give you a roadmap of what we're going to discuss in this lecture, we're first going to start the lecture by talking about standard of living as our approach to measuring long-run economic performance and growth. We'll then talk about the measurement that we use, which is real GDP per capita, and how that's contingent on labor productivity, and that's contingent upon improvements to long-run factors, and that's contingent upon investment, and that's contingent upon savings. And then we'll finish off the lecture by talking about average annual growth as a useful measurement, the rule of 70 to help kind of do a back of the envelope calculation of economic growth over time. And then we'll finish the lecture by talking about convergence theory and other basic macroeconomic theories. So we have spent time analyzing economic variables that can measure our level of macroeconomic performance in the short run. So gross domestic product, unemployment, inflation, things of that nature are all useful in understanding short-term fluctuations in the economy and to kind of give us a pulse of how things are going currently or over a small period of time. But essentially, the economy is not only interested in just kind of keeping the fires put out and things staying afloat, but we want to continuously grow and become more productive over time, beyond just having a job or beyond just getting tasks completed and not being in a recession. And so the way we're going to measure that long-run economic performance is by improvements to our standard of living. Now, the question is, how do we measure our standard of living? So our standard of living, that measurement that we're going to utilize is we're going to take that real GDP measurement that we utilized for short-run economic analysis, and we're going to divide that by the population of the country that we're analyzing, and that's going to give us a measurement of real GDP per capita. So what is real GDP per capita kind of estimating? Well, real GDP is a measurement of income in a country. And so if we divide it out by the population, that basically says that if income inequality didn't exist, every person, every citizen of a country made the same amount of money, what would be that level of income that that average person would make divided out across babies, teenagers, children, retirees, etc.? What would be the average? Now, in our society, we don't have that flat, evenly distributed income. We have a certain level of people that are very wealthy and highly compensated. And we also have people that are low compensated or making minimum wage or something slightly above that. And so while it's not perfect, it does give us a good estimate of how wealth is distributed amongst countries, because the United States and China effectively have the same real GDP per capita, around 18 to 21 trillion dollars, so to speak, in any given year over the past few years. But where the United States and China greatly differ is in the fact that the United States only has about 330 million people and China has about 1.5 billion people. So we're looking at a factor of 5 to 6 times more people in China than there are in the United States to make the same amount of productivity in terms of income. And so as a result, because of that population fluctuation, it does create a big gap in terms of overall standard of living in China versus the United States. But again, income distribution is not factored in here. It's something that we can talk about as a potential problem in our society in terms of wealth distribution. But generally speaking, this is a good kind of starting point or back of the envelope calculation for how we're going to estimate the overall standard of living in a country. So this graph is from the Federal Reserve Economic Database, which is run by the St. Louis Federal Reserve District Bank in the Federal Reserve System. And they do a good job of accumulating very useful data sets that can be publicly accessible, downloadable in CSV files or Excel. There are certain statistical packages that can import this data. You can learn to web scrape and open source statistical packages and software and actually scrape this data off the internet because it's publicly available. Or there are other statistical packages like eViews that allow for you to have a plugin that just pulls the data directly from the website. But again, if you're familiar with R, Python, or other programming languages, you might be able to just do that yourself. Or someone might already have a program that you can install that does that for you. Regardless, the Federal Reserve Economic Database has this graph that shows real GDP per capita over time since World War II. So the vertical gray bars represent recessions that have occurred in the United States since World War II. And even though that we've seen those drops in real GDP during those recessionary periods, I mean, the Great Recession was one of the worst, well, the worst recession since the Great Depression, but you see relative to the overall fluctuation in real GDP per capita since 1945, that is only a slight dip in terms of the overall standard of living in the United States. Which begs the question, would you have rather lived through the Great Depression or the Great Recession? You might have lost your job in either case, but losing your job and maintaining a standard of living that is metrically substantially higher than it was even during World War II or the years subsequent would probably be an easier time to live. And so our standard of living has continuously increased since 1945. And again, standard of living is something that we want to improve. We want to make our lives easier. We want to have higher wealth. We want to have that American dream that everyone talks about. Obviously, even though our standard of living on average across the United States is getting better over time, that also doesn't necessarily mean that everyone's getting better at simultaneously. So there can be some individuals that are struggling in spite of this, but overall on average, the standard of living has improved. So the reason why you're taking a class in school, there's focusing on the short run things of getting exams done, passing exams, finishing assignments, coming to class, listening to lectures, doing homeworks, doing presentations. And really the reason why you're doing that is a means to an end. Your goal is to get 3 credits or 4 credits or however many credits the course is listed for, and credit towards a degree that you're trying to achieve. And hopefully that degree will be indicative of skills that you've acquired to potential employers, and then those potential employers will hire you at a higher compensation. And the goal for that is to be able to have a higher compensation, so maybe someday you can have a family if you don't already have a family, maybe buy a house, maybe move to a city or an area that you want to go to, maybe be able to travel or start a business. All of these things are long-run goals that you're building towards, and that's what the economy reflects, because again, the economy is always a reflection of our society. So what determines long-run economic growth? Well, it might seem strange, but the variable that we can use to estimate improvements to long-run economic growth is going to be labor productivity. Labor productivity is just the value of production that one worker produces in 1 hour of work or whatever unit of time that you want to use, and it's usually measured in dollars, so like dollars per hour. And what this really just speaks to is how efficient is a worker in doing their job. The more efficient we make our employees and our labor and that factor of production, then the more productivity that they can have per hour, which means that there's more productivity per day, which means there's more productivity per year. And GDP is usually measured annually or quarterly. So if you're going to be able to produce more in an hour, then you're definitely going to be able to produce more in a 3-month period or a 1-year period. So labor productivity is going to basically be a de facto variable that essentially shows us the improved efficiency in our workforce and overall our improved efficiency in producing goods and services in general. So as our labor productivity goes up, then that really results in a higher level of GDP over the same period of time that it was in the previous year, which allows for that distribution to have a higher level of average wealth. So then the question becomes, what determines labor productivity? Well, there are three major factors that go into improving labor productivity, and you might want to think about this in the context of the production possibilities frontier. So the production possibilities frontier said that, okay, if I improve the amount of technology that I have, or I improve the amount of resources that I have, I can produce more as a country, as an individual, as a business. And so these are effectively saying the same thing. If I improve the amount of technology that I have, then I'm going to be much more productive as a worker over a certain period of time. And so essentially, that means that I'm going to have improved labor productivity, which means I'm going to be able to produce more, be more efficient with the same amount of resources. The second one is physical capital stock. So physical capital stock kind of speaks to machinery, equipment, and tools that the laborer has at their disposal to complete their tasks and get things done. So if they have more physical capital stock, ceteris paribus will learn that basically there's a limitation to how much improvement you can get with physical capital stock improvement. But generally speaking, it still benefits me. So if I've given a hammer to hammer a nail into the wall, I mean much more efficient than using my head or my hand or some other weird tool. The third category that determines labor productivity is human capital. And human capital is just the skills and education that a worker or the labor force in general possesses. So the reason why you're in school is usually to improve your human capital. You're acquiring additional skills, you're acquiring additional education that's going to make you more competent in different tasks, and that's going to allow for you to command a higher salary on the job market. And the reason why it commands a higher salary on the job market is because you're going to be more efficient at doing your task. So these three things working together can really improve our labor productivity. And there's a graph that's usually drawn that shows the relationship between labor productivity and our physical capital stock. So let's say this is our capital stock in terms of dollars. And this is our labor productivity, which we'll measure in dollars per hour. The way the graph is usually visualized is if we don't have any technological or human capital improvements, we have this type of growth. There's initially an exponential growth because if I'm given a hammer or a computer to do a task that I had to do by hand before, I'm going to be much more efficient at that task. But if you give me 600 hammers or 17 computers, unless I'm combining and splicing together their computing power, I'm not going to really be able to effectively utilize those computers or those hammers beyond the initial ones that I receive. So there's a limitation in your productivity as a result. You can't just throw money at it or throw tools at it unless you have the ability to utilize said tools. But if you improve technology and you improve human capital, so if we improve education, we improve the amount of technology that we have, for a given level of capital stock, we can continuously improve the labor productivity that is associated with it in terms of dollars per hour. If you ever go to graduate school or take an upper level macroeconomics course, this is a very, very simplified explanation of what's known as the Solow model. And so basically you have a diminishing marginal returns to capital, which is what this is saying. And then if you improve productivity in terms of technology, you can shift this curve up and be more productive than you otherwise would be. So again, long-run economic growth requires constant improvements to our productivity. However, in order to achieve this, you have to invest. So realistically, if you're going to school, unless you have a scholarship of some form, you have to pay for your tuition out of pocket, which can come in the form of saving up for it. So you can make an investment on yourself in terms of acquiring additional skills that will hopefully make you more money in the long run. Or you can borrow money that had to have been saved by somebody else or borrowed by somebody else, which had to be saved by somebody else. So if you're taking out government loans, the government's probably borrowing that money, just like any sort of transfer payment. Generally speaking, these days, a lot of it is borrowed in form of treasury bonds. So they borrow it, but then someone else is taking on that security because they've saved up enough money to provide that liquidity to the government. Regardless, in order for someone to invest in improvements, so if you're going to buy new equipment, new machinery, that's an investment in your business and you hope to get a return on it. If you go to school, you're hoping to get a return on your investment. If you are trying to improve your technology, doing research and development, that's also going to be a significant investment. And in order for that money to be invested, it has to be saved up by somebody. Because if you consume all your income, then you don't have any money for anything for a long run type of development or growth. And so basically what I'm getting at is that investment and savings are going to be interlinked. In order for you to improve those capital stocks or the human capital or the technological advancement, you need to be able to invest. And if you want to be able to invest, you're going to have to save in some way, shape, or form. So savings and financial systems are very important because they allow for investment to be fostered. So in the United States, we have substantial growth every year. We're a very fast-growing, fast-moving economy. We're not necessarily as fast-growing as other countries, but we're also starting from a much higher level than other countries might be growing from. We have the highest level of income in the world, tied with China. Effectively, we go flip back and forth with 1 and 2. But overall, we have the most income, so if we're still growing at a 3% rate, that means we're doing pretty darn well for ourselves. Now, in order for firms to raise funds or individuals to raise funds and invest, they usually won't necessarily reinvest their profits. They can, but they'll either give up a share of their company in the form of venture capitalism, so they'll give up, say, 10% of their company for an infusion of cash into their business. Or they'll just borrow the money in the form of loans and issuing bonds and securities and things like that. Now, in order for people to be willing to participate in that system, they have to believe in a strong, sound financial system. Now, this can go and be pared down as low as we need a legal system. So when we first talked about the market system, there's a legal basis behind it because we need to define what's yours and what's mine, and that's property rights. And we also need to be able to define what is going to happen if you don't hold up your end of the bargain, and that's known as contract rights. So if that happens, then people are more likely to participate in the market system because they believe in the faith in it, and they trust that it's going to work out. Now, in the United States, we're fortunate to have a very sound financial system. Lots of people participate in it. And that allows for a lot of investment, and that allows for a lot of the growth that happens above that leads to labor productivity and these improvements to our GDP per capita. Now, in terms of a sound financial system and what benefits it provides, so again, there's kind of this kind of chicken to the egg situation where basically if we have a sound financial system, it gives us even more benefits. So not only does it give us the benefits of being willing to invest and save and create growth, but it also provides additional benefits for people who are willing to invest. And those are risk sharing, liquidity, and information. So risk sharing is the situation where basically we can diversify our funds. So I could buy cryptocurrency and I could buy Apple stock, or I can buy Google stock and I can invest in a pharmaceutical company. I can invest in Coca-Cola and I can invest in Disney. All of these are different businesses in different sectors. I can invest in Lockheed Martin. I can buy gold. So all of these things, I can diversify my assets instead of just putting all my money like a roulette wheel on red or black. I can basically put my money in different assets, and if one of them struggles, it doesn't mean that I'm go bankrupt. And generally speaking, even if the stock market falls substantially, I'm still not going to lose necessarily everything unless I have very volatile stocks of businesses that are tenuously still around. The second benefit is liquidity. And so liquidity is just the availability and the ability to turn assets into cash easily. So we talked about this benefit in terms of securitization. Basically, if I have a bond that I buy from a corporation or the government, I can sit on that bond and get paid back plus interest on the date of maturity, or I could just sit on it, or I could just trade it in for cash now. So if I find myself in a cash crunch, I could just basically lose some of my interest that I was going to generate on that, or maybe even some of my principal. But overall, it's better for me to have that cash now than to go under and just have a bond that won't really matter when my business doesn't exist anymore. Still get the money, but it would probably be an asset that would be distributed to creditors in bankruptcy, so it doesn't really do you any good at that point. And then the last one is information. So stock prices and the stock market basically are indicative of how the market in general feels about that business. The flow of it and the trajectory of it is indicative of that. I liken this to sports gambling because the reality is that the sports bettor, the sports book, the relationship between the sports bettor and the sports book is there's lots of people that are very smart that are betting on sports, and there's also got to be very smart people that set the lines. And the line itself gives you information about what people believe and what the market believes. Part of it is what's known as the VIG, which is basically the profit margin that they make, just like a casino has odds in their favor, so they make money over a very, very long period of time and millions and billions of simulations. But in terms of sports betting, the individual who knows a lot about the thing is already going to know how much the bet is worth, and so the casino has to be close to meeting those demands or else they're not going to get the action. But for a person that doesn't know anything, they could just take all of that hard work that the sports book has landed on and just kind of read it as an, okay, well, this, because the line is like this, I think that this team is probably going to win, so I'm just going to bet on that. So you don't even have to think, you just bet. Now, is that a smart strategy? No. But by virtue of that information, it allows for you, or it doesn't necessarily allow for you to be better off, but it allows for people to believe enough in it that they're going to actually part with their money and take that risk. So all of these benefits allow for more participation in the system. Now, as I mentioned before, just to recap, labor productivity is kind of our way of saying this is how long-run economic growth changes or fluctuates. And that is all contingent upon the level of technology, physical capital, and human capital that's available to firms or how much they're willing to invest in those avenues. Now, investment is based upon savings, and the availability of funds is basically contingent upon people being willing to participate. So you could save your money but not actively participate in the system. So they kind of go hand in hand, and you need them both in order for the system to work much more efficiently. But generally speaking, investment and savings are linked, because if you don't save, then you can't invest, and if you don't save, there's no money in the bank for the bank to invest. And then if there's no savings, then nobody has any money at any time to build for the future. They're just spending now. And then when everything comes together in the future where the bill is due, they don't have any money. So this is the problem with people who are bad with their money, is they spend everything. Their marginal propensity to consume is so high. It's like over 1, which means that they're spending more than they're taking in. And then they're just discounting the future so much that when time comes, then just kind of everything falls apart. But where I'm going with this is the fact that savings and investment can be proven, assuming in a closed economy, very simply, that they are the same. So if our measurement of income is GDP, and when we're talking about a closed economy, we're saying that that the entire international trade aspect of GDP isn't there. All the borders are closed off. We're not trading with anyone else. We're just producing domestically and spending domestically. If that's the case, then our GDP equation goes from consumption plus investment plus government spending plus net exports back just down to C, I, and G. So income is C plus I plus G. Now investment, if we just rearrange the equation and move I to the left-hand side and Y to the right-hand side and switch the negatives or flip it around so it all stays positive, investment is going to be income, which is Y, minus consumption minus government spending. Now, what we want to do is we want to see how can we calculate savings and see if that is the same right-hand side as investment is. So we can break savings into two specific types. We have private saving, which is kind of saving by households and firms. And so that's going to be represented by Y, which is our income, plus TR, which is going to be transfer payments. So remember, transfer payments aren't part of GDP. They're direct payments from the government to households. So that can still contribute to spending and saving, but it's at the discretion of how much the household spends. So income that's available to be spent is going to be transfer payments from the government plus the actual income that they earn. The outflow is going to be consumption, obviously, because that's the component of GDP that is spending by households on goods and services. And then taxes, because taxes, when you get your paycheck, you don't get 100% of your paycheck. You get a fraction of it. Well, a big fraction, not a small fraction, but a big fraction of it. And then a decent chunk of that goes straight to taxes. So whatever is left over after Uncle Sam takes their fair share, you spend money, that is private saving for the economy. Public saving is the government's way of saving, which never happens anymore. But effectively, it's going to be the tax revenue that they take from you, minus the transfer payments that they've already directly paid to you, minus government spending, because G is the component of GDP that represents the spending by the government. If you add those two together, then you get this that cancels, this that cancels, and you're left with Y minus C minus G, which is here, and that's going to be total savings in the economy. Investment up here was Y minus C minus G, so effectively investment and savings are the same. So this little proof shows us that investment is contingent upon savings because investment is derived directly and exclusively from savings. So now I want to turn my attention to how has long-run economic growth changed over time on Earth, basically, as a human civilization. So hopefully that little recap before gave you insight as to kind of how long-run growth develops. So again, I said it can get as simple as, so that doesn't even tell you the whole story. So we need a sound financial system, we need savings, we need investment into human capital, physical capital, and technology, and then that improves our labor productivity, which improves our overall productivity over a period of time. But even below the financial system, we need those legal rights, we need those property rights, those contract rights, we need political stability, we need kind of a lack of war or revolution or anything like that. And that kind of sets a foundation in which we can build upon. If we don't have that legal structure, then we aren't really going to be successful. So again, I just want to turn my attention to talking about long-run economic growth over time. So if we go across the entire human existence and civilization, from the beginning of humankind to 1300, AAGR represents something that's known as the average annual growth rate. And so the next slide will talk about what average annual growth rate is. But basically it's just taking the amount of growth that happens year over year and dividing it by the period of time that you're analyzing and saying, okay, well, every year on average, how much did the economy grow? Well, between the beginning of humankind and 1300, we saw basically no growth economically in the world in terms of standard of living. We were hunter-gatherers, we were agrarians, agriculturalists. There were certain people that were very happy and successful in empires and civilizations and things like that, but the average person and the average level of growth didn't really change. Once we moved to the year 1300 and moved to kind of the beginning, basically 1300, so the Middle Ages until the Industrial Revolution, our average annual growth rate improved because we started moving a little bit more to a centralized society. That agricultural activity kind of picked up in terms of its efficiency. But still, across the world, our average annual growth rate was 0.2%. So that means for every year, we only grew by 0.2%. And if you look at how society was back then versus the way it is now, 0.2% of that doesn't seem like very much. Once we hit the Industrial Revolution and moved into the 19th century, our average annual growth rate accelerated substantially, and we went to a world growth rate of about 1.2% per year. That's pretty significant, and that might not seem like a lot, but once we talk about what's known as the rule of 70 and couple that with the average annual growth rate, you can see how small fluctuations make a huge difference, which is why it's kind of really important to focus on when you're taking out a car loan, a mortgage, student loans, etc., to look at kind of that interest rate to see how that's going to fluctuate things. And then in the 20th century, things accelerated even more with the advent of new technologies, and our average annual growth rate doubled to about 2.3% per year. So things were getting pretty crazy in terms of growth over the last 100 years. So how do we calculate average annual growth rate? Again, it's just the summation, so that sigma symbol represents adding. So if I give you a certain set of, if you know what the growth rates are year over year for your country or for some other entity, you can just add those up, and then you divide it by the number of years that you're measuring, and then that'll give you the average annual growth rate. So for the example below, if we have a growth rates over a 6-year period, we can just add 1.6, 2.1, 3.0. We would subtract 0.5 because we lost 0.5% that year, add 0.8% and add 1.9%. And the sum of that is basically 8.9%. We divide that by the number of years, which is 6. And so we find out that our average annual growth rate is 1.48%. So what do we do with that? Well, it really depends on what the average annual growth rate is representing. If it's representing real GDP, it's talking about how much the economy overall is growing. If it's talking about real GDP per capita, it's talking about how much standard of living is changing over time. If it's just debt in general or it's an investment that you're making, then that's talking about kind of the growth of the debt or the growth of the investment. Now, again, another back of the envelope calculation we can do is to use what's known as the rule of 70. And so the rule of 70 is just basically a rule that simplifies an estimation of how long it'll take you in years to double your initial investment. So you might have, in other books, might say the rule of 72. Both of them are acceptable. But basically what it's saying is that if you take that average annual growth rate as a whole percentage and you put that in the denominator and put 70 in the numerator, that quotient that you receive is going to tell you how many years it takes you to double your initial investment. So if it's representative, so if the average annual growth rate is representative of real GDP, it's telling you the number of years on average it will take to double your economy size. If it's real GDP per capita, it's telling you how many years it's going to take for your standard of living to double. If it's an initial investment that you're making, then it's just telling you how many years your debt will double or your principal will double. So in the previous slide, we calculated an average annual growth rate of 1.48%. So if we take 70 and we divide it by 1.48%, we get 47.29. So that 47.29 represents how many years it'll take for this, whatever it is that we're measuring, to double. So let's just say it's real GDP per capita. Then it's saying that at an average annual growth rate of 1.40%, our standard of living will double in 47.29 years. So about 47 years, 3 months, and a week or so is how long it'll take for our standard of living to go from where it is today to where it will be in the future. So again, small changes in average annual growth rate can make a big difference. So when we went from the 19th century of having 1.2% growth per year to the 20th century where we had 2.3% growth per year, our economy really substantially accelerated over that period of time. So even though it was only a 1% incremental change, if you use this rule of 70, 1% difference is, well, it depends. So if you're growing by 1% per year, 70 divided by 1 says your economy is going to grow or double in size in 70 years. But if you go to 2%, I mean it's only a 1% difference, but it's doubling the growth, and so that would mean that it would only take you 35 years to double your economy size or standard of living if you have a 2% average annual growth rate. And the reason why this is so effective is because of what's known as compounding. So you might have heard of compounding interest. So I have a couple of equations here. Continuous compounding is the PERT equation, so it's principal times the exponential function to the power of the rate as a decimal times the number of years, which is t. You can also do a compounding over a certain period of time. So if it's monthly, n would be 12. If it's daily, it would be 365. But basically, you can do the same calculation with a different rate of compounding with the second equation there where it says 1 plus r over n to the nt power. So the exponential function basically it's a constant, but it has to do with logarithmic functions, well, the inverse. But basically, if you use this information, and Italy has an average annual growth rate of 2.8%, and Argentina had an average annual growth rate of 1.4%. Well, Argentina and Italy basically had similar real GDPs per capita in 1950. So over the course of 60, 70, 80 years, if Italy had an average annual growth rate that's double that of Argentina, even though it's only a 1.4% difference, it's going to result in a substantial fluctuation in terms of real GDP per capita over time. And we could even use the average annual growth rate relativity between the 19th century and the 20th century, where it took, or even the period before that, where if average annual growth rate is 0.2%, it would take, using the rule of 70, it would take 350 years for the economy to double in size or standard of living to double. In the 19th century, if it's 1.2% per year, then that's telling you that it's going to take us a much substantially less amount of time. In fact, it'll be about 58 years and 4 months to double our standard of living. And in the 20th century, that went from 58 years and 4 months to about 30 years and 3 months. So substantial differences lead to, over a long period of time, to have this divergence between the standard of living in Argentina and the standard of living in Italy, or how much the economy truly grew over that period of time. So if we actually take that 2.3% per year and we take 100 and we divide, 70 divided by 2.3 gives us about 30.43 years. If we do 100 divided by that answer, that tells us that the economy's standard of living in the 20th century doubled 3.2857 times. Now, if you want to figure out how much the economy actually grew, well, if you're doing doubling and doubling and doubling, well, then it's actually an exponential function. And you would do 2 to the 3.2857 power. So if we do that, we actually will find out that the economy increased 9.75x over the 20th century. So the economy's standard of living and size increased by tenfold effectively. So if you were born in 1900, your standard of living was 9.7 to 10 times bigger in the year 2000 on your 100th birthday. Remarkable differences. Now I want to turn our attention to something that's known as convergence theory. The reality is that the United States has a substantially high level of income, but eventually that rate of growth is going to become smaller and smaller over time, not because we're not trying to, but generally speaking, if our GDP is $20 trillion and we want to have 3% growth, that means on top of producing another $20 trillion worth of stuff in final goods and services next year, if we want to grow by 3%, we're going to have to not only produce that extra that 20 trillion that we produced the year before, do it all over again, but we're also going to have to produce another $600 billion worth of stuff on top of that. So even though our population is growing by a little less than 1% per year, 1% of people producing 3% more is a pretty tough feat to do, which lends itself mathematically to this concept known as convergence theory. The assumption here is that for a high-income country like the United States, it's going to be very difficult for us to improve our standard of living at a high clip forever into perpetuity. But for, say, an emerging economy or a small or lower income country that's in, say, Africa or South America or Asia, the reality is that they only need small incremental changes to have substantial changes to their standard of living. So the theory says that because low-income countries only need small incremental changes to have big growth and high-income countries need substantial to get little growth, that eventually over time the standards of living in all of these countries will kind of converge towards each other to the point where basically every country in the world will have similar standards of living. So the question is that true or not? You might think, oh, well, that makes sense mathematically, and it kind of does, but the reality is that it doesn't happen. So here's a scatter plot of, on the y-axis we have our average annual growth rate of real GDP per capita, and on the x-axis we have the initial actual level of real GDP per capita. So what you should expect is that those countries that start on an initial real GDP per capita should be closer to the x-axis in the bottom right corner, and those with very low initial real GDPs per capita and standards of living should be kind of above that 7% range, and those green dots should be like way in the top left corner. Unfortunately, it's not happening on that trend line. In fact, it's almost backwards in the fact that the poorest countries in terms of standard of living have close to zero growth rates or growth rates that are at least slower than their high-income counterparts, and even some of them, like the Central African Republic, have negative standard of living changes. So for a country that's among the poorest in the world, you would think, okay, maybe their standard of living would improve dramatically just from small incremental changes over time, but the reality is they're actually going backwards. So why is that the case? Why does the trend line not follow? Well, these are 4 examples of things that prevent countries from catching up. Not listed here is resources. So think about certain countries that are in desert climates or climates in which it's arid and it's difficult to grow vegetation or irrigate or farm to get materials that you would need to produce goods and services that your citizens would need. That's going to be a difficult reconciliation in terms of your standard of living. Because if you have to import everything, then you're not really going to be in a high standard of living. But notwithstanding that, really one of the major reasons why countries don't catch up is the failure to enforce the rule of law, which is why I said it's so important, even though I didn't mention it directly in the slides, that those property rights, those contract rights, that legal system, that basis there, a lack of political turmoil, no bombs going off, no political revolutions happening. Everyone's aware of the consistent laws, the consistent property rights. They know that they're enforced. The contract rights are enforced. Then people will be willing to participate in the system and invest and grow. But if those things can't even happen, if we're just focusing on a day-to-day thing or a short-run thing, they're not going to be concerned about, okay, what's our tax policy that's going to help us benefit our research and development arms of our country. They're going to be more worried about getting food on the table, making sure people aren't dying, making sure that the infrastructure is solidified, so they're not really worried about long-run outcomes, and so that's reflected in the data. Additionally, a lack of a health and education infrastructure. So this is almost like a chicken-egg situation again, where it's like we need the savings and the investment of people to participate, so there's cash and money available. So we can invest in this infrastructure, get more students in school, have more healthcare, because if you're a healthier person, then you stay on the workforce longer, and if you stay on the workforce longer, it takes less time to train you, and if it takes less time to train you, and you're not sick and you're not leaving your job, then you're going to produce more. But if that infrastructure isn't there, then we're going to struggle. And then lastly, again, if you don't have a sound financial system, whether it's because there's a lack of trust, maybe there's corruption or embezzlement happening in the government level in terms of government contracts, or just you don't have enough financial capital in your system to be able to have these leaps and bounds of growth, you're going to struggle at the rate in which you grow. So the last thing I want to talk about speaks to economic theories. You are not necessarily responsible for knowing about all these economic theories, but the two that I have highlighted are going to kind of be the main two theories that we discuss in this course. We've already talked about it with inflation. The classical theory of economics suggests that inflation is not an issue because wages and prices simultaneously adjust. So that way your real wage is constant. Keynesian theory differs from that. Keynesian theory was kind of birthed out of the Great Recession when we had 20% unemployment, people were out of jobs, things weren't getting better, and the classical theory didn't really do anything to address those problems. And so Keynesian theory really focused on fiscal policy, which we'll learn about later, in terms of, okay, let's invest in government programs, let's have the government spend to kind of boost the economy so that way people will start working again, then they have money, then they spend that money, that incentivizes more people to produce, to start new businesses, and then the economy kind of gets jump-started. But it was also based, but in order to get to that kind of conclusion, it also had to base and change the assumptions. So they were like, well, guess what? My wage doesn't instantaneously adjust when prices do. And furthermore, we don't just assume that our productivity, or we're always in a state of full employment, or we're always in a state of equilibrium. There's frictions in the market that not only cause this deviation between prices and wages changing, but it also prevents us from potentially achieving our equilibrium at any given point in time. And so we've talked about this with unemployment, we've talked about this with inflation, and when we talk about the aggregate economy and aggregate supply, aggregate demand, monetary fiscal policy, all these things will come to bear again. And so really these two theories are the ones that you need to focus on. But just a couple of other theories. Monetary theory focuses on the 70s when we had stagflation, low economic growth, high price fluctuations. Milton Friedman and Anna Schwartz basically came out with a paper that suggested, hey, maybe monetary theory is the way to go and we need to be consistent with it instead of this reactionary type policies. Later in the 70s, we kind of revived the classical model, and that's known as rational expectations, where basically through the argument of technological advancement that information would be passed so quickly and the agents that are assumed to be hyper-rational that basically things would adjust so fast that it would basically simulate the classical model. In the 90s, we moved into the real business cycle model, which focused more on kind of business cycle fluctuations and growth models and things like that allowed for us to have a little bit more realism into our markets. And today, what we've kind of emerged into is what's known as the dynamic stochastic general equilibrium, or DSG models, also known as the new Keynesian model. And so basically what we're doing is we're using the Keynesian theories of old, but instead of looking at it from a top-down perspective, we're looking at it from a bottom-up perspective. And we're starting to see the emergence of what are known as micro-based macro models, which means that all of the assumptions and optimization stuff that you would learn in a microeconomics course is built as the foundation of the economy, and then we just aggregate that by a million or a billion to try and estimate kind of, okay, what is the overall behavior of the macroeconomy based on all these people doing these weird and crazy things. So that is probably going to get us closer to a more realistic approach of macroeconomics. The only consequence with it is very complicated, very hard to teach at an undergraduate level, basically impossible at an undergraduate level. But it's also requiring lots of computing power, so you have to be very well versed in data science to be able to do these things. They're known as recursive models that basically every time something changes, it not only updates. So when things change, we look at data points. So like if GDP goes down, then we see that the last period it was this level, this period it's this level, and so as a result we see that that change has happened, and then we're reactionary because of that change. What a recursive model will do is it'll take that new piece of information and say, okay, well now I have more data to base all my other theories on and all my other time periods on, and it updates the entire model. So instead of it just being like, oh, well, 1972 is fixed at 1972, it'll take that new information of 2020 or 2021 or 2022 and basically use that to revise the estimates of the previous years. So it's very interesting. It's very high-level stuff, but it is kind of the future of economics, but it's not something you necessarily need to know in this course. So where we're headed next is to talk about the aggregate economy. And so the aggregate economy is kind of where we set the stage for kind of the remainder of the course. We are able to aggregate the economy to a point to see, okay, what are all the inner workings and underpinnings that are going on that cause this very strange behavior that we call a macroeconomy. And then from that, when we have short-run and long-run types of issues that we have to reconcile, we can use that framework to kind of see how policies can help aid or harm the trajectory of the economy. So again, that concludes this lecture. If you have any questions, please feel free to reach out and be forthcoming with those questions. Otherwise, I wish you the best of luck on your assessments, not only in my course, but any other courses that you may have. Thank you.